What we saw in Bitcoin over the last year to the upside, from 10,000 to 65,000 in less than a year, we could easily see that sort of action out of silver.
This week's special with Miles Franklin Precious Metal Investments, 2021 Type 2 American Silver Eagles for only $7.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Michael Oliver. He is from Momentum Structural Analysis. They've been providing research and information for more than 30 years. Michael, thank you so much for joining us once again today.
Good to be here again, Elijah. Thank you.
Our last interview had quite a response. Got 70,000 views. That's one of the top interviews we've ever done. And so we really wanted to have you back on, have our viewers have the chance to ask you some questions. The first question is from a viewer, and they're wanting to know more about your momentum analysis and how it determines that, in your perspective, silver is about to break out. And they're specifically wanting to know, why do you see it's going to go past the $26 to $30 range? That it seems to be kind of really need to get above that if it's gonna go much higher.
Yeah, that's sort of the upper end of the range we've been in since the surge last July, which peaked in August. And then we dropped rapidly within 6 weeks of that high. It was almost 30. It dropped. Well, remember, silver went up 50% in 3 weeks there, okay, in July. That's a quantum leap, okay. It dropped back under 22 after making that high. Did that in early September. And then since then, it's been caught between that high level, basically 30 level, and the low 20s. Right now, we're 24, give or take. It's been a big congestion zone with a lot of up and down swings. So a lot of people think it's been going down, but actually it's been going sideways in a range that's well above where it used to live, which mostly was under 20 for quite a few years. Our momentum work, essentially when we create momentum charts, what we're doing is we're taking price and measuring it not against its dollar value or a euro value or whatever fiat currency most people would measure assets by, because that's a rubber yardstick. I mean, the Fed has proven that this year. I think we had a 25% increase in money supply in a matter of half a year or so. Normally it doubles every decade. So your yardstick may say $1 on it, but it keeps depreciating in its real value because of the quantity, the river flows of dollars, okay? Same is true with the euro, the yen, and so forth. So it's a distorted yardstick. So when you measure something like a thermometer in your mouth to touch your temperature, you don't want that to change. You want it to be a constant. In other words, you change, but the thermometer doesn't. If it did, you couldn't trust it, right? Same with the yardstick. If you had 36-inch yardstick, and it actually grew every month by an inch, but still said 36 inches, you don't have an objective measure, okay? So fiat currencies are not a good way to measure things. And some asset managers of high quality and name have essentially said that. Ray Dalio, for example, recently has said, don't trust the money unit. How do you get away from that, though? I mean, because, everything's quoted in dollars in the U.S. So what we do is we measure price and its relationship to a moving average that it sets the direction and the speed of. Yes, the dollar is still involved in the measurement. So if we quote gold at $1,900, we're measuring it, though, not against the dollar so much as we are against, let's say, a 3-year average, 3-quarter average, 3-week average, et cetera, where you're looking for short-term to long-term swings in its relationship to that average. So if you're concerned about the short term, you want to look at what? Something like daily momentum, maybe weekly momentum, concerned about what's going to happen the next 2 weeks. But when you're concerned with the big picture, you look at things like annual momentum, like where's price in its relationship to above or below a certain average, and you plot that as an oscillator. So what you end up is a price chart picture, but it's an oscillator above and below a zero line. And it creates the same type of patterns that price chart analysts are looking for. Let's say uptrend lines or floors where it comes to the same level on the oscillator and stops, or ceilings above it. And so what we're looking for are structures the same way that price folks look for structures, so they can define when a trend breaks. The difference is that momentum will usually establish a new starting gate in a new trend direction well before price ever gives you that information. So usually you'll get a momentum breakout before you'll get a price breakout. So you have a little heads up there. What silver has done over the last year, it came from excessively high momentum levels. I mean, when you go from the teens to $30 within 3 or 4 weeks, you're off the page on a momentum chart. I mean, it's like a rocket ship. So you're very overbought at that point. So you needed to cool things off. Now, you can do it either by going down or going sideways for a period of time. Why? Because if you go sideways for a period of time, that moving average, let's say a 3-year average or a 3-quarter moving average, is rising. And therefore, the momentum readings are pulling back toward the moving average or toward the zero line on the oscillator. I know that sounds confusing, okay? But essentially what we do with momentum is we try to partly separate ourselves from sheer price chart analysis, which is heavily distorted by the money unit itself. So that's why our method is different, and we see things differently quite often than what people see when they're looking at a price chart. In the case of silver, while you've gone sideways in a big range, the momentum chart has gone down in a trend, and you've had rallies and drops and rallies and drops where you can draw a downtrend line. In fact, there's a 4-point downtrend line right now on silver that you cannot see on a price chart. Price is just sideways noise. But on momentum, it's a perfect 4-point downtrend line when you measure weekly closes in their relationship to the 3-quarter moving average, which is sort of like a 200-day average, but you only change it once a quarter. But there's a perfect momentum trend structure set up now to break through. In other words, one of our sayings is you can't break a trend unless there's something to break. Well, on momentum right now, you have something to break to the upside. You have a multi-point downtrend line that is super clear, and it's not clear on the price charts, which is great, which means we'll get the heads up for the price chart folks do. And like you said, most people are looking up there near 30 for a breakout. Our breakout number's about $1.50 above this week's high, which doesn't mean too much on a price chart, but when you look at our momentum chart, it's a massive structure. And that's what we look for in any market. We look for trend structures to set up on momentum, and when we see them set up, usually when they set up the structure, they will come. Okay.
Now that next price target that you mentioned, about $1.50 above this week's high.
It's about next month. It's going to drop. I mean, of course, that's a few weeks away. The 3-quarter average will adjust down a bit to about 25.76, and that happens to be where the structure is. This quarter, it's 25.98. So if you look at a price chart, draw a line, circle that point at 25.98 this quarter, it's in the middle of nowhere, or 25.76 a little lower next quarter. It doesn't seem to be meaningful. But when you put it on the momentum chart, it's a very meaningful breakout level. So, we got up to the upper 24s, I think, in this recent rally after being in the low 22s. If we can get up another $1.50 or so above this week's high, we're going to engage that downtrend line and break out. In which case, at that point, we think the trading range that we've seen in silver for 13 months now will end with an upside resolution. Gold has a similar situation, but its structure, instead of a downtrending structural momentum, is totally flat. It goes back to March of last year. It's a 1.5 year wide structure that is perfectly clear. You could, like Braille, you could read it with your fingers almost. You don't see it on a price chart, but there is a structure on gold that says, well, for example, you get out to next quarter, which is a few weeks away, around this week's high, 1830s, you'll be breaking out over a massive structure, which will engage gold out of its doldrums. It's been going, well, net on balance, we're in the 1800 area. You know what the peak monthly close was back in 2011? 1825. So we've been messing around on either side of the old 2011 high for a year plus now. No collapse, no explosion, just messing around. Well, momentum has built a structure during that time such that when we pop that number, and if silver pops its number, and they'll probably do it about coincidentally because they're not that far above those numbers, then we expect that the monetary metals are going to take off again. And we expect the next move in silver to go up and challenge the all-time highs, which were, of course, we all know $50 and $50, 1980 and 2011. So that's where we think silver will go next once it comes out of this congestion zone.
No, that's a good transition to this next viewer's question. we have actually from Brandon. He's wanting to know why so many people who talk about, silver breaking its all-time high, if it moves above $50, that could be really a time in which silver just takes off after that. He doesn't understand the reasoning behind that. Is that your view? And if so, why?
Well, first off, we don't think 50 will stop you on a third attempt if you get up there. Because first off, the ratio of silver to gold is still pretty low right now. Silver's outperforming gold, by the way. If you go back and measure how silver's done since last summer's breakout, it not only broke out on momentum last summer, that our price was $19.40 some odd cents. It surged to 30 within 3 weeks. That was an annual momentum structure that broke out there. If you look at price, that $19.48, our breakout level last July, didn't mean anything. There were other highs slightly above that, and it took them all out in a breath. But at the time that it broke out on net trend and had surge, it also broke out relative to gold, meaning if you plotted a chart that measured silver versus gold, you would see that the silver broke out, technically speaking, against gold, meaning it's an outperformer. And it has continued to hold its outperformed gains versus gold over the last year or so. And we think it'll continue to outperform gold going forward. That's sort of normal in a monetary metal bull market in the past. Silver generally beats gold. It's not always the leader. In other words, it doesn't always start the bull market as a leader. In this case, it certainly didn't. Silver broke out really solidly last summer. When did gold turn up? 2015 low. I mean, so gold had a head start. But silver's now in the lead in terms of relative performance. The gold bull trends that we've seen over the last 50 years have all been about eightfold moves. There's been 4 of them. Eightfold measuring from the bear market low that preceded the gold move. If you go back and look at it, 1970 to 1975, 1976 low to 1980, they're all about 7.5 to 8-fold moves in price. What was the bear market low in gold in 2015? 1,054. Well, it says 8,000 would be sort of a normal, another 8-fold move. Why not? The money's degraded that much anyway. So that's one thing gold does. It keeps you ahead of the degradation of money. Well, if gold goes to 8,000, silver isn't going to be at $50. Silver's going to continue to outperform. We suspect that silver, if you go back and look over the last 50 years, you can see many times where silver was 3% of the price of gold or higher. And if you ever get to $8,000 gold, for example, just another normal ratio move, silver's not going to be at 50. It's going to be in the stratosphere compared to where we are now. We estimate 200 or so. So the issue right now is not that. The issue is let's get out of this congestion zone that we've been in for 13, 14 months now in silver and gold. And when do we do that? And that's what we're focused on right now, and I've already given you the explanation, the momentum structures that are pending, not far above the both markets. And once you engage them again, I've thrown out the suggestion that what we saw in Bitcoin over the last year to the upside, from 10,000 to 65,000 in less than a year, we could easily see that sort of action out of silver.
This viewer is wanting to know, they say, you are looking for this 8-fold move in both gold and silver. What is the possibility that gold and silver will correct while markets come down before that big move? Well,
they have been correcting. I mean, actually, if you go back to last August high, they've been correcting. In the case of silver, it's been up, down, in a sideways range. In the case of gold, it had a downward zigzag, and we're now right back at smack in the middle of the ink of the last year. From the peak to the low, we're right in the middle of it. So we have been correcting. But think about it. If you look at an S&P 500 chart and think about investor sentiment, we've gone from the 2009 low in the 600s to 4,500. And yes, there have been 20 and 30, we had a 35% crash in February, March last year. We had a 20% collapse in late 2018. And there are many other times I can point out to you where in a matter of a few months, the S&P has dropped 20% or more within the context of this huge parabolic, very aged bull trend. It took gold from August last year to March of this year to finally give up 20%. It took it that many months. It took the S&P less than 2 months in late 2018 to drop exactly that much. So in a way, if you'll stand back and look at it, gold has been holding up better than the S&P has during its bull trend in terms of the speed and percentage of drops. Stock market, we think, is a variable that will affect gold positively. And we think it will help it when it tops and goes down. We think the S&P and the U.S. market in particular, which is the most overvalued of all the developed economy stock markets, NASDAQ 100 in particular, are in a process of putting in a top. Now, you don't see any evidence on the price charts yet. It won't take but another, I'm just going to throw out a number for you. 1% or 2% drop in both the NASDAQ and S&P right now will engage some lesser momentum factors to the downside. In other words, it's like breaking your shin bone, not the backbone. We think if we can drop the S&P like down to the low 4,400 area, it's in the high 4,400s right now, it's going to start to break enough stuff to where you're going to get some sell-off. Nothing major or dramatic, I don't think. But there's some long-term momentum factors, particularly evident to us on NASDAQ 100, which is the leader index. It's heavily weighted with the leadership symbols that are, overwhelming percent of the weight of the market. Microsoft, Amazon, Apple, Google, and Facebook. That if we get an intermediate downturn, it could very easily topple into a longer-term breakage, in which case we've begun the downturn. Now, put yourself in the position of Powell. Lagarde just said, head of the ECB, we're not tapering. Foot's on the floor, it's going to stay there for a while. So she's not going to do any tapering, at least for the time being. The Fed, they all talk about how they're going to taper and all this stuff. A lot of the economic numbers that they've been focused on, unemployment in particular, and a lot of other numbers, they're really not where the Fed wants them to be. And if you'll read Powell's words in print at his conferences the last few months, his official statements, it's very subtle, but he is not that happy with some of the major numbers they want to see achieved. And he also says, I want them achieved over a period of time so we know we really got our numbers. They haven't even gotten to the levels they want. So he's got an excuse in the background there not to do much tapering anyway. But if that stock market becomes a negative, and it hasn't been since last summer, certainly, it's been vertical. So that's not been an issue they've had to deal with to want to support. And as I've said in most of my interviews, Bernanke wrote a paper in 2003 saying one of the implicit tasks of the Federal Reserve is to support the stock market. He gave his reasons why. No, it's not in the policy book about what the Fed is there for. But he says it's a very important factor because it causes consumers to spend when the stock market's good, makes people feel good even if they're not in the market. And spending is better than savings because that's what causes all the numbers to look good. And so if that stock market becomes a negative, that suddenly is going to cause the Fed to have to reconsider any tapering they may begin or not begin. And we think we're pretty close to that point where the stock market could become a factor again. It's not been a factor, but it's very important. And so if, in fact, we're correct, the stock market is about to top and give some evidence of that. Nothing dramatic again, not margin call, panic, and hair pulling out like we did last March. But enough to where the Fed gets concerned, then any of this talk of tapering is going out the window. And if they did begin to taper, they'll reverse policy. Because there's a lot of people in the markets and a lot of people not in the markets pay attention to the markets. So it's not just the 1%ers or the 2%ers who are in the stock market making money because the Fed's printing the market up. But even people not in the market realize, because they went through it in 2008 and 2009, that when that stock market goes down and their industrial company stock goes down, they might get laid off. In which case they tell their wife, cut back on the spending, dear. And that's what the Fed doesn't want. So the stock market is extremely important. So if you're long gold or silver or wanting to get long, you want to watch the stock market because we think it would be fuel to the upside in the monetary inflation that the Fed is creating, and therefore the wind at the back of gold and silver.
Now, speaking of the stock market, Jason is wanting to know if there are any markets or any other inversely correlated markets to gold and silver. Some people point to the 10-year Treasury yield or the dollar index. Your perspective, what markets should we look at that will be inversely correlated with precious metals?
I would say right now we've been positive on T-bonds and T-notes, as not because of expectation that rates are going to go down, which they've done. Of course, as the bonds rise, the rates go down. We think that's primarily the effect of asset class preference shift, especially among large asset managers, fund managers, who've said, hey, listen, I've been here before, but this 12-year bull market stocks is a little bit nervous for me. I'm going to shift a small percent over to T-bonds and park it there. Not because I love the rates I'm getting, but because it's like cash on the sidelines. And so there are two markets that they put the money in. One is gold and one is T-bonds. And it's very interesting that when did gold make its low for the pullback? March. When did T-bonds make their low for their recent pullback? March. Okay. Now, T-bonds are under some pressure recently, but we think there's probably one more spurt in the T-bonds to the upside, meaning a further drop in yields. But we think that's not a trend. It's a counter trend rally. And it's an effect of that, again, asset class managers moving money into those two arenas. And they've also been buying gold because we're well off the low. 1673, we're trading around 1800, okay? There's a point at which, however, and I think we could reach it this year, where T-bond rally ends, yields quit dropping on the 10 and the 30. This would be true with the German bonds and the Japanese government bonds as well. And rates start to rise. And T-bonds go down in price. Now, at that point, we think the bond-gold correlation, which is of late for the last year been fairly positive. They've been in pretty much agreement for that reason, the reason of the asset class preference shift into safe areas. But we think at that point, after the next surge in bond prices, drop in yields, bonds could then enter a bear trend and divorce themselves from gold, leaving basically gold and silver as your only inverse alternatives to a weaker stock market and to a rising rate environment. Now, we know the Fed wants to keep rates low, but their primary controls are in the very short end of the market, not in the 30-year bonds. That's more an effect of investor preferences. And so we think that could also become a negative, an inverse to gold, is the T-bond market. We enter a period of higher yields, much like in the late 70s. So other inverse markets, commodities we think will be sympathy with gold as a broad category. Right now, our favorite commodity has been natural gas. We think it could basically double in price rapidly because it's very low and technically it looks very positive. But we think in general the commodities will tag along with the rise in gold and silver, but not outpace them, not beat gold and silver. So they're not a preference to gold or silver. But the other inverse markets are primarily, again, the government debt markets we think will turn bearish, but not now. And the stock market is likely to make a top soon. And even show some evidence on price charts. And people sit back and say, wow, this is getting a little nervous. And the Fed will be saying the same thing to themselves, which could, of course, put their policy into forward motion continually, along with the ECB. Dollar is also a factor. Dollar has been going, if you'll objectively look at it, since last July, it's been going sideways in about a 3.5% range. Right now, you're about smack in the middle of that range, wandering aimlessly. Occasionally, you'll get a strong week and a strong month in the dollar. People say, oh, look how strong the dollar is. Stand back and look at it. Look at 40 years of the dollar index, and you'll see it isn't strong. It's lame, and it's in the lower quadrant of the last 40 years of descent. We think there's another leg down in the dollar. To give you a number, we're trading above 92 right now on the dollar index. You get down under about 91.50. Don't bet on the lows holding. By the lows, I mean the lows of the last couple of years have been down below 90 in the 89 area on the dollar index. We think you'll go flushing through that and go down probably and challenge the all-time lows of the last 40 years, which are down near 70. And that's a big move for the dollar. I mean, Forex markets, the euro and the dollar, they don't move 30, 40%, not like some commodities, okay? 5 and 10% moves are pretty substantial. We think the dollar is about to break down out of its year and month-wide range and re-engage to the downside again. Probably something you're going to see in the next month or two. Now, that would be further wind at the back of gold, although we have to state pinning the trend of gold on what the dollar does is a waste of time, especially for the last 5 or 6 years, because if you did, the dollar's been in a broad sideways range of about 10% range. Gold doubled in price without a major bear trend in the dollar. So it didn't need the dollar to be weak. But we actually think the dollar could contribute at this point by another leg down in the dollar. So that would be an inverse. But again, on the forward exchange markets, the percentage moves there are pretty small compared to what, let's say, the stock market could do in a bear trend. It could shed 50%, and the dollar shed 20. So the percentages just aren't there. We think it's a good background thing to measure.
Now, I think this will be our last viewer's question, but Eli is wanting to know about investing in precious metals. So if people are interested in really taking advantage of this move that may happen, we can't guarantee that, obviously, but if people are looking to put some of their funds into gold and silver, what is your perspective on the vehicle to use? There's a lot of different ways of doing it. They're asking specifically about physical precious metals and your perspective on like bars, rounds, coins. What's your perspective?
Any of the above. It depends on the investor. If the investor has, it depends on the amount of capital they have, what their time frame is. Are they 85 years old, or are they 25? And all these things affect investor actions and capabilities. Some people are used to dealing with leverage in futures. Some people prefer non-leveraged positions, like you could buy a bullion ETF, which is non-leveraged, the GLD or the SLV. You could buy Sprott Bullion Trust. He's got silver and gold bullion trusts, as you buy in bullion effectively. You can buy coins if you want the physical aspect of it, or bars, whatever. Again, it depends on the investor. What does he want it broken down into? Small units so he can resell it or trade it, or wants one big bar? It's all up to the investor. We also suggest that, and this is very frustrating for many investors, the gold mining and silver miners. We describe them as little dogs on a leash. They're yapping and running backward and forward in front of the mama or the papa, the silver and the gold markets. So when silver and gold go up, they tend to rush out in front and outperform gold. When gold pulls back, they underperform gold. They act scared. And sure enough, since the recent highs in the dollar, like GDX, for example, the gold mining ETF, the various ETFs, they've had a little bit more pullback than gold has had. But that will change if gold and silver break out on our numbers. We think the miners will snap back into a leadership position on a relative performance basis. And so in the longer term, we think probably you will do better owning gold and silver miners. And I think I'd emphasize silver miners just like I'd emphasize silver over gold. So we think ultimately that's the better place to be. But it's hard to tell current gold mining investors that, because they feel like, oh gosh, this is frustrating. Again, the major issue is, when do you enter? And if you entered at the wrong time, you'll feel pain in any market. It's true with gold and silver as well. But if you take a longer term perspective, don't get too leveraged. Don't put a time fuse on it like a call option, and be patient. And if you feel uncomfortable, then make your position comfortable in terms of dollar amount. But as far as the specific vehicle, that's all up to the investor and his talents and money.
All right. Well, Michael Oliver, we really appreciate your time today, and I'm sure our viewers definitely do as well. Where can our viewers find you online if they're interested in learning more? And did you want to share with the viewers also any last thoughts you had?
Well, our website is olivermsa.com. MSA stands for Momentum Structural Analysis, so olivermsa.com. Request some samples. You can see some on there. You see also a discussion of our methodology, why we have it, how it works, and so forth. We think that the primary focus of investors now should be gold and silver. You can be short the stock market at the appropriate time, but we think that even if the stock market entered a new bear, which it's overdue for time-wise, price-wise, value-wise, and every other reason, we're looking for the technical reasons, even a major bear market there probably is not going to match the percentage upside we're going to get out of gold and silver. So we still think that's probably the place to be, again, with an emphasis at the right time on gold and silver miners.
All right. Once again, Michael, thank you so much for your time, and God bless.
Thank you much.
This week's special with Miles Franklin Precious Metal Investments. 2021 Type 2 American Silver Eagles for only $7.25 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.